Welcome to the first LPEA webinar of 2025. We wanted first to wish you a great 2025 vintage, filled with many new successes, interesting projects, and certainly great events. There was no better topic to start the year rather than really ELTIF 2, because really that's a hot one. It's really a trend, and we're absolutely convinced that Luxembourg's position is very promising and that we also have very strong cards also for the future. For example, we have all the required experience with different investment fund structures. 36 years of liquid funds, 20 plus years of alternatives, all in all, that's exactly what you need. So to have the right toolbox, the experience, and to know how to really work with that kind of new, very promising products. Next to that, we have also a very fully fledged ecosystem composed of best-in-class asset servicers and also the right practitioners and talents. That's also very important in order to drive that growth. And we also have that kind of important democratization trend we have talked a lot about over the last years, which is also now becoming really a reality. It's a new page in our history. It's important that we tackle it well, that we enlarge also the scope of investors and those types of investors, that we propose new models, new distribution models, and that we also really remain very realistic about it. This is a great opportunity. It should be also taken with the highest quality standards because there is some reputation at stake. We have fared quite well, and we absolutely intend to pursue also that kind of, again, great move in the future. And also it's important to keep transparency and also performance and operational excellence at their highest. So we are absolutely, let's say, on the good sides. We count on you, and we know that this will be one of the next big hits of the Luxembourg financial sector. That's it on my side. And now I'm very happy to pass over to Maria, and thanks a lot again to our very active committee and all the speakers of today. Thanks a lot.
Well, thank you very much, Stefan. Hello, everyone. My name is Maria Rodriguez, and I am the co-chair of the Private Funds Committee organizing this webinar in collaboration with the ELTIF Committee at the LPEA. I have the pleasure today of introducing you to our topic and speakers, where we look forward to diving into the various questions, opportunities, and themes that surround European long-term investment funds. As I'm sure you are already very well aware, the ELTIF 2.0 regulation was introduced in March 2023 and is effective as of January 2024. In the last year, the ELTIF 2.0 has become the hot topic on the Luxembourgish market and was complemented by a variety of publications and guidance that have now completed the body of work. The new ELTIF 2.0 regulation has welcomed amendments that range from the scope of eligible investment assets to new structuring possibilities. And with 89 ELTIFs registered to date, Luxembourg takes a leadership role in the ELTIF market. And today we will hear from the various professionals that lead in this field to know what the current standing of ELTIFs is, but most importantly, to catch a glimpse of what the future opportunities in this field hold for the market. We will have two panels for you today. The first panel will focus on the trends and state of the market, while our second panel will focus on the business opportunities introduced in 2025. Our first panel welcomes Tom Slowcock, who joins us from iCapital, where he is currently a managing director and head of international product development and structuring. iCapital is a global financial technology company powering the world's alternative investment marketplace as a trusted partner. Ron Henry joins us from EQT and is currently the EU regional head for evergreen product development. EQT is one of the world's largest investment firms with 242 billion euros in assets under management, invested across private capital and real assets. Ezekiel Havren joins us from SumUp, where he is currently a senior fund advisor working on the launch of a pan-European loan origination fund focused on European SMEs. Silke Bernard joins us from Linklaters, where she is currently a partner and global head of investment funds and a leader in the industry efforts to promote ELTIFs. Jennifer Boer joins us from Maples Luxembourg, where she is currently an off counsel in their investment funds practice. Thank you all very much for being with us today. Before we begin, to our audience, please feel free to raise any questions you may have during the webinar in the chat. We will do our best to get to these at the end of the webinar, but to the extent not possible, fear not, we will be following up with emails. Let's begin. Over to you, Silke.
Thanks very much, Maria, and good morning, everybody. Good afternoon, wherever you may be, and Happy New Year from my side as well. Thanks very much for joining this joint event between the Private Funds Committee and the ELTIF Committee. I think it's a very logical topic to join efforts on. And it's definitely an exciting year ahead. So we do have, as Maria just said, ELTIF 2.0 now complete with a full set of rules. The RTS finally adopted, and in our first panel, starting now, we will look into some of the where do we stand, current state of ELTIFs, but also the improvements that ELTIF 2.0 has brought. And we have market players with deep insights in what ELTIF looks like and what the experience is. So before we start with that, let us briefly set the scene. Jennifer, can you tell us in a few words, which are the asset side changes that came with ELTIF 2.0 and which we are talking about?
Absolutely, Silke, thank you. So as ELTIF 1.0 was considered generally too restrictive, the EU legislator has implemented in ELTIF 2.0 a number of positive enhancements, namely on the eligible asset side and on the diversification and concentration rules. On the asset side, ELTIF 2.0 provides for a wider range of eligible assets and permissible investments, namely by introducing a broad definition of real assets, by increasing the marketing capitalization threshold for eligible listed qualifying portfolio undertakings, or by also including the possibility to invest in fintech assets by amending, namely, the definition of qualifying portfolio undertaking. ELTIF 2.0 also introduces less prescriptive investments and diversification rules by lowering the minimum investment in ELTIF eligible assets from 70% to 55%, by also permitting fund-of-fund strategies and master feeder ELTIFs, or increasing borrowing limits from 30 to 50% for retail ELTIFs, and also allowing borrowing of up to 100% of the net asset value for professional ELTIFs. And finally, also in January, also increasing the diversification requirements. So over to you, Silke, on the distribution changes that were brought by ELTIF 2.0.
Thanks, Jennifer. Yes, indeed. Alongside the investment side changes, there have also been a number of sell side changes, which were also identified as being a barrier to the uptake of ELTIF 1.0. So the first is a potentially very important change, that is we have now two ELTIFs, retail ELTIFs, which probably raise most interest because of the retail passport, but we now have also professional investor ELTIFs only, which different rules. I will not go into detail, but that is a change, and I see starting interest into professional ELTIFs coming as well in the market. But on the retail side, there were a number of changes which make it easier to bring the product to the investor, which is, of course, the purpose of any investment fund, and certainly ELTIFs. So the hard thresholds for investment of retail investors have been abolished. Instead, the rules about selling ELTIFs to retail investors have been pretty much aligned with the MiFID framework, with some adjustments. So, for instance, the suitability test can be overruled by certain investors in specific circumstances, which makes it easier, for instance, to sell ELTIFs to like the very top part of the retail investors. The very high net worth investors, for instance, could benefit from that. And there are a number of clarifications around the withdrawal rights, around classes, the equal treatment, and so on. So a number of things which make ELTIF much more easy to navigate and to handle. And with that, setting the scene, let me come to the most interesting part, that is speaking to our GPs and getting their insight. So Ron, let me start with you. You have built a lot of experience with ELTIF 1.0. So what are your views on ELTIF 2.0 and the changes? Will it be a flop or a success? And what are generally your views on ELTIF?
Sure. Thank you, Silke. I'll try and maybe address each of those points, but maybe first and foremost, I think my general view is that this iteration, brings us closer to what looks like and feels like a typical mutual fund. I think that's important. It enables managers like EQT to develop a compelling private wealth product and bring it to market. And then it also enables managers through that compelling offering to be able to bring private clients into the alternatives asset space. So, which of course is a key tenet of the regulation. So more concretely, however, I think there's maybe three buckets of changes which excites us. One is the change around eligible assets. So again, here, the inclusion of AIFs and the ability for managers to get access to assets which are already undergoing value creation. I think that's important to deploy capital faster, to provide liquidity within, again, that offering. So this is one of the things that excites us. Then second, the diversification changes as well is probably another bucket here. So again, the move away from 10% to 20%, again, looks very similar to what you conventionally see in a typical mutual fund. And then last but not least, I would say, the liquidity changes. So here, where there is a nod of approval around the fact that LTIFs can be now open-ended or offer regular redemptions, subject to the liquidity provisions that are set out, as well as the incorporation of the liquidity matching mechanism. So, I mean, in short, I think, exciting changes, and especially they all trend towards the possibility of developing something which looks a lot like a conventional mutual fund. Whether or not it's is a flop or a success, I think remains to be seen. But I suspect what we might see is a proliferation of LTIF fund of funds and the ability to aggregate capital and allocate that to tier one GPs such as EQT, essentially.
Thanks, Rod. That's super interesting insight. Jennifer, over to you.
Yes, thank you, Silke. So over to you, Ezekiel. You're joining us for SumUp, and understanding that SumUp is in the process of launching a loan origination fund, more specifically LTIF. What are the features that drew you to use an LTIF as a structure, and is ELTIF 2.0 really changing much of anything for you?
Like, it's a very good question. For us, the driver was we wanted to be able to lend to the merchants, the SMEs, part of the client base of SumUp. And the first aspect that we looked at is how large must an SME be? And so we did a clearance with ESMA, and ESMA concluded together with us, and we're very happy about it, that unincorporated SMEs like family businesses also qualify as undertaking for the purpose of the LTIF regulation. Now on that base, we continued the journey and thought of, is there markets where a rollout will be impeded, and their LTIF was really the go-to product for us to be able to pursue the strategy of providing capital to help those businesses grow. And based on our research and discussions with regulators here and there, together with advisors, we have landed that LTIF was the go-to product. Now the cherry on the cake, if I may say, for the capital deployment is also the sourcing. I think Silke rightfully pointed to the source of capital being on the equity side. For us on the debt side, we looked at also the borrowing rules, because under ELTIF 1.0 there was a limitation in the event that the provision of capital, the deployment of capital that you would make as an LTIF would be through loans or some form of debt instruments, but here for us through loans. You were not allowed to borrow in order to lend. Now, even though we are not pursuing the strategy of borrowing directly at LTIF level in order to lend, it is a cherry on the cake, as I call it, and it's a welcome change.
Thank you very much, Ezekiel. Silke, over to you again.
Yes, Tom, let me come to you. So, can you talk to us? I mean, one of the most important question marks in LTIFs is that it's a regulated product. So can you share with us some of the insights in your experience with CSF? How well have they understood product? What was the approval process, the response times, and so on? And do you generally feel the regulator has a good understanding for LTIFs and the balance between alternative assets and potentially retail investors?
Sure. I think as Maria mentioned, I mean, the proof is in the pudding a little bit. As Maria mentioned, Luxembourg seems to be dominating the LTIF space, certainly in terms of what I would call broad distribution LTIFs. So that would suggest that the market thinks that the regulator is doing something right. Our experience is that the CSSF is shown itself to be very commercially engaged in terms of wanting to retain that status and understanding the LTIF as a very significant growth opportunity. Clearly, responsiveness and timing to market are key metrics for all applicants. And what we see is that they're sensitive to, let's call it a potential competitive threat from other jurisdictions. And certainly in Q4 of last year, we saw final approvals coming through sooner than had been anticipated. So they were certainly on the ball. I think one of the things to think about is as the volumes grow, and I think we probably all expect those volumes to grow, then any regulator needs to ensure that the process remains speedy or as fast as the market is looking for it, but it also remains efficient and also robust and consistent. And so I think that's something that we'll need to be sensitive to, is that how do you retain exactly the same responsiveness and the same views, given that we're all learning exactly what the market is going to be looking for. While the rules are there, clearly it's still a new business. In terms of your question around the balance, I think the regulator does understand. I think that the product, whether they really understand the implications and the consequences of some of the rules on all market participants, I think is a question that we'll find over the coming year or so. And I think there are very different levels of desire and interpretation across the market in terms of what people are looking for. I do think we as an industry need to help the regulator in some ways, in that this is a new product set, taking a new asset class into the retail client base. And we need to think carefully about how we do that as a collective industry, rather than relying on the regulator to kind of manage it entirely. Let's all be aware that this is a huge opportunity, but it's also, there are significant risks to this potentially going wrong.
Thanks. And generally, Tom, are you satisfied with your experience? So are you happy so far?
Yeah, I think it's been good. I mean, in a previous life, I was involved with ELTIF 1.0 back in, I mean, it's almost 10 years ago now, which seems like a long time ago. And I think that the market has changed dramatically. The market appetite in the wealth space, the wealth channel for private markets has grown dramatically. ELTIF 2.0 has changed things fairly significantly, and I think the regulator has embraced that. So I think that this is a huge opportunity, but like any huge opportunities, we need to execute effectively.
Right. Thank you very much for these insights. Jennifer?
Yes, so finally, I would like to ask a question to all of you. And I guess it will be kind of summarize what has also been said in the past few minutes. But what are the key opportunities you see really in terms of structuring, asset classes, investment strategies, and distributions now with ELTIF 2.0 specifically? Shall we perhaps start? Who is ready to start? Perhaps Ezekiel, yeah?
Sure, I think I will just echo what Ron was saying. I think a big item, if we are targeting the retail market, is fund-of-fund strategies and access to easy deployment strategies, you know, with those managers already active in the market. And I think this is a very, very welcome improvement in the regulation. So I welcome that as well.
Absolutely, I agree with you. Ron, Tom, would you have something to add?
Sure, I can maybe I would echo the same and a lot of the comments of the others. Maybe one point here is on the distribution side. I think, you know, how we will think about this is looking at what is the opportunity set that the LTIF framework opens up as compared to the vehicles we currently have within the toolkit. So, you know, drawing a comparison to what does this unlock as compared to a Part 2 UCI. You know, so where is there white space in terms of maybe new markets or existing markets which were previously inaccessible? So that's I think you know, is let's say an opportunity in and of itself. And yeah, of course, again, the ability to kind of make this distinction between a retail and professional offering ties into the same consideration. So yeah, perhaps I'll leave it there. I think those are kind of top of mind for us.
I think kind of pulling both of those together, and I think the thing that makes the LTIF unique is the ability to bring it to retail clients within the EU. I think what we've seen so far is much of, not all, but much of the LTIF distribution so far has still been through the wealth channel, I would call it, and as mostly as a specific product, as part of a sort of a broader portfolio. I think, and I don't know whether it'll happen this year, but I think at some point you'll start to see LTIF product coming available through the retail distribution more than the wealth channel, perhaps. I also think that perhaps you'll see sort of product coming to market, which will be a kind of a combined savings product, whether that's a fund of funds or whether that's a combination product, whereby it's more of a savings product as opposed to part of a portfolio. And then the other thing potentially which may happen is the appreciation or the take on of the LTIF regime for jurisdictions outside Europe, whether that's whether that kind of that quality of regulatory oversight is important in terms of making it available to clients, to retail like clients outside the EU.
That adds to our tasks we have within the various industry committees we should work on. So certainly looking beyond Europe would be a very nice win for LTIFs as well. So can I give you a challenge to our three speakers? Can you summarize in one word the one key message you want our audience to take away before we go to the second panel? Just one word. Ron, what is the one word you want people to take home with them?
I would summarize it as access, I guess. Again, just given the developments we see here, I think it enhances the access. And so, yeah, I would say my takeaway is access.
Okay. Ezekiel?
Proof of concept is not quite one word, but I think the proof of concept has been made with LTIF 1.0. The regulator, the legislator has learned or have learned from the drawbacks and just made something better.
Great. Tom, your one keyword?
I just go opportunity. This is a great opportunity. for us in this industry to be part of at the right time.
Excellent. I think that sounds very positive. Jennifer, anything you want to add before we hand over to the second panel?
No, I would really like to thank our three panelists. Their input was really, really interesting. And I hand over back to you, to Maria.
Thank you very much. And indeed, a huge thanks to the three of you. You have deep insights, and sharing it with our audience today is really much appreciated. So with that, I hand over, I think I hand over back to Maria, right?
Yes, thank you very much to our first panel. It was very interesting to hear your insights. And while we let our next panel prepare for their round, we want to hear from you, the audience, and we have a couple of questions to ask you. So we would like to ask you to participate in a brief questionnaire by voting on your screens. The questions should be coming up now. The first question that we have for you today is, what is the most exciting opportunity presented by ELTIF 2.0? Is it perhaps an optimal structure for fund-of-fund strategies, an optimal structure for evergreen strategies, or do you see it as an improvement for distribution? Our second question is, are you looking to set up an ELTIF in 2025? Yes, no, or perhaps after our very interesting webinar, you will be considering it. Our third and last question for you today is, how do you see Part 2 funds and ELTIFs coexisting? Is it ELTIFs taking the form of a Part 2 UCI or Part 2 UCIs being upgraded to ELTIFs? We'll let you take a moment to vote. And that's very interesting. So for the first question, 42% believe that it will present improvements for distribution. On our second question, it seems that 46% will be setting up an ELTIF in 2025. So I think the speakers in this group will be very, very busy. That's great. And on the last question, it seems to be a 50-50 split. So between ELTIFs taking the form of Part 2 UCIs or Part 2 UCIs being upgraded to ELTIFs. That's very interesting, and thank you all very much for voting. Then we now move over to our second panel that focuses on the business opportunities introduced in 2025. Our second panel welcomes Victor Tarsitano, who is currently head of European and Asian shareholder services at Goldman Sachs Asset Management. Goldman brings together traditional and alternative investments and provides clients around the world with a dedicated partnership and focus on long-term performance. Charlotte Lavie-Daufort joins us from LPEA Asset Management, where she is currently the co-head of the Infrastructure Transition Platform. LPEA Asset Management is the asset management company of Crédit Mutuel, LPEA Group, established as a key and responsible player with 55 billion euro of assets under management, both in public and private market. Stéphane Aubert joins us as a partner from Aubert Law Firm, where he focuses on the setup of alternative investment fund structures and all regulatory and corporate aspects in relation thereto. Lastly, Joanna Pesnick joins us as a partner from Herbert Smith Freehills, where she specializes in fund and asset management, including ELTIFs. Welcome all, and thank you for being with us today. Stéphane, we are looking forward to hearing your insights for the upcoming year, so over to you.
Thank you very much, Maria. Good afternoon and happy New Year to all. Thank you for attending this second panel. We heard a lot of positive and interesting insights on the trends and state of the market during the first panel. Let's now look forward and focus on the business opportunities ahead. We have a lot to cover, so let's roll. Victor, if I may put you first on the grill, how do you anticipate the ELTIF 2.0 regulation will impact investor demand and product structuring in 2025? And maybe as an underlying question, are there specific sectors or asset classes where you see significant growth potential?
Thank you, Stéphane. I think I'm going to echo what Ron said in the first panel, where he said, essentially ELTIF 2.0 is a big step towards making it look and feel a bit more like a mutual fund, something people can understand a bit more. I think that's right. It does come with some complexity, the fact that 2.0, allows for a lot more diversification in portfolios, etc. And we'll come to that complexity a bit later. But really, it starts with the advisors and distributors. Those who are sitting there with their book of clients who may traditionally not have had any alternatives on their books. That's the market we need to tap into, and that's the advisor base we need to tap into and educate from a distribution perspective. I can't remember who it was. Maybe Tom was talking about distributing via the retail channels. That's essentially what Goldman's been doing. Is looking down that traditional retail channel. But our experience has been there isn't much education in this space, and there are lots and lots of advisors with clients that just do not have alternatives on their books today. That's not where they specialize, and they just need some time and education on what the opportunity here is. And of course, that will then drive your end customer demand. The more savvy end customers, they'll be reading, they'll be paying attention, and they'll be seeing this, approaching their advisors, approaching their the traditional platforms where they buy these products, and you know what, they may not even find those products available. In terms of asset classes, Stefan, it's not an area where I specialize, but there's no doubt that infrastructure debt, private credit, they stand out. These are areas where the retail investor typically wasn't able to get access to, and if they can do that now, fantastic. And if they can do that in a tax efficient way, which I know some jurisdictions are encouraging, then even better. And I'm sure Charlotte will agree with me on that.
Joanna, over to you.
On the same line, let me ask you if you expect that more specifically the infra debt strategy will gain traction as a result of, amongst others, the simplified definition of real assets under ELTIF 2.0.
Yes, thank you, Joanna. In terms of prospect, effectively, the ELTIF label is well suited to infrastructure debt, which is a long-term asset in line with the European objective to fight against climate change and decarbonize the economy. And the European infrastructure debt market is in the energy and digital transition the most dynamic today, and therefore is a field of development for ELTIF in 2025. For example, we had created 2 infrastructure debt funds in the form of a Luxembourg RAIF ELTIF SICAV, and they have already invested in green loan and also green bonds, but mainly green loan to finance, for instance, independent power producer of renewable energy, and we anticipate that this trend will continue.
Thank you. Sorry, go ahead.
And maybe in addition, from the investor side perspective, even though obtaining the ELTIF label is demanding and due to the process of approval by the regulator, we consider that it provides to the investor, even for institutional investor, additional protection, having the regulator reviewing the documentation of the ELTIF fund. So that's also a positive trend in favor of the ELTIF label.
Thank you, Charlotte. I'm going to stick with you. So ELTIF 2.1 has significantly facilitated lending on a pan-European basis. This has been particularly beneficial as it allows key players to overcome the necessity of interposing a local vehicle when engaging on cross-border lending in certain jurisdictions such as France. More specifically, how has the evolution of ELTIF 1 to ELTIF 2.0 unlocked new opportunities for infrastructure debt investors?
Effectively, we see the ELTIF label as a facilitator for lending in Europe. Thanks to the possibility of direct lending in Europe, our infrastructure transition fund can maximize its access to the primary market, which is mainly a banking market. And it allows us to identify the best opportunities in terms of remuneration. And for our investors, it allows us to optimize the illiquidity and complexity premium of our investment strategy. This is compared to a multi-tier structure or alternative investments such as instruments such as bonds. And to answer the question on the evolution of the LTIF regime from LTIF 1.0 to LTIF 2.0, it is true that this evolution has contributed to relax some constraints in the selection of investments. Maybe an example to illustrate this positive evolution. We were faced with a constraint of LTIF 1.0 in a situation where we wanted to invest in a debt issued by a listed infrastructure company. And due to the level of capitalization maximum in LTIF 0.110, we were not able to do this investment that were meeting all our other criteria. And these constraints was relaxed with the LTIF 2.0 regime, with the increase of this maximum capitalization threshold. So that's a positive. We see this evolution as very positive, and this is why we have integrated the LTIF 2.0 rules as of January 2024 in our existing funds. And based on this positive experience, we consider continuing with this LTIF 2.0 label for our next vintage of infrastructure debt.
Thank you, Charlotte, and over to you, Stéphane.
Thank you. Vic, sorry, I should have mentioned you're not on the product side. So with that disclaimer, you're now fully covered, and I apologize to come back to you with another question on products. Despite a slowdown on the sustainability side, sustainability and digital transformation are hot topics in the industry. How do you see LTIFs aligning with macroeconomic trends like sustainability and digital transformation?
Well, I think following a certain inauguration yesterday, it's hard to know where macroeconomic trends are going to go, right? But there's no doubt that governments are looking to attract public and private investment into a huge range of infrastructure projects. Coleman has always run a long portfolio and long roster of infrastructure funds, and demand for that is still there. It's a good opportunity for the LTIF. Again, gives that retail investor access to that sort of asset class that perhaps they wouldn't have had traditionally. You're right. I'm not a portfolio manager, but the relaxation of the rules does give that option either for the LTIF to invest directly or via other funds, through fund of fund structure. I guess the real challenge, if I can start moving it more into my space, being the more distribution and operational side, is can the fund accountants keep up with that sort of thing? You've got to aggregate at this point, what are typically labeled as real assets, your traditional, alternative investments, with your liquid assets. And that's where you start to get into a little bit of the headache that the opportunity LTIF actually brings.
So I'm going to give Vic a break and turn down to Charlotte. With the revised framework lowering barriers for retail investors, what strategies are you considering to make LTIFs more accessible and attractive to this demographic? And are there any unique challenges you foresee in tapping into this expanded investor base?
Yes, effectively, one of the major current trends we observe is the democratization of private debt, and more precisely infrastructure debt for retail clients. This has been already touched upon in the previous panel. For instance, last year, we at Ark Asset Management launched an infrastructure debt fund for private wealth management clients. And this was a positive experience, and we see in the following of this experience, we see several initiatives on the market to create retail funds using this LTIF 2.0 label. This is, for example, the case in France, where the Green Industry Law, which came into force at the end of 2024, provides for the possibility of including private debt fund with the LTIF label in UC funds of insurance company. So that's the case in France for on the basis of French vehicles for the time being. And these initiatives, we think they are very interesting, and we are looking at this possibility among other market participants to create such as a retail fund with this ELTIF 2.0 label to be able to distribute it widely into the retail clientele of Arkéa Asset Management.
Thank you very much, Charlotte. Vic, may I ask you the same question?
You know, infrastructure debt, private credit, yeah, that's where we really see the demand. Yeah, I don't know that the ELTIF in and of itself, yes, it makes it more accessible, more attractive. You know, I'm not sure that the ELTIF, you know, by itself, without that further education I talked about earlier to the advisors, you know, does it? It's quite a challenging question that you're asking there, because it's you know, it's not the ELTIF that drives, you know, a strategy necessarily. It's, you know, what we see the market do, and then what we want to bring via the ELTIF, if that makes any sense.
Yeah, it does. So maybe now moving to more your core activities, Vic. So entities such as iCapital have been helping distribution through the creation of feeder funds. And is that essentially for you the best model for distribution of retail alternatives?
Yeah, look, it's a good model for the distribution of the ELTIF, but that's a selfish way of thinking about it, right? What entities like iCapital do by aggregating, putting things through feeder funds, I would say the same about any entity that can then create an omnibus account, is that you take the operational headache away from the asset manager, the fund account, well, more the transfer agent really than anybody else. But you do move it upstream, and it is important that entities such as iCapital, you know, are able to cope with what happens next. So you aggregate positions, you give the fund a single position, and that's great. The fund then reports one position, it then calls once, you know, capital once, it distributes once. But it is important, and this is what's going to build faith in the ELTIF longer term, that those administrators like iCapital have the capability to break that down further into the underlying clients. And that's both from an actual transaction payment perspective, but a reporting perspective as well. It's yeah, it is lovely to receive, you know, a feeder fund flow. Let's not kid ourselves, it's not cheap. There are costs to that. Those costs have to be borne somewhere. And yeah, as an asset manager, we can choose to help absorb a lot of those costs through rebating or through a distribution fee. But you know, it is essentially a good model, and you know, we do partner with iCapital and others for that specific reason. But it does present a lot of operational challenges doing that when you put everybody into one bucket.
Thank you, Vic. I know it was not programmed, but Tom, you want to comment that in a few words?
Just trying to come off mute. Yes, I mean, the first thing I'd say is, without sort of trying to promote iCapital, is that yes, historically we were driven, you know, we were driven mainly by feeder funds, but clearly there are businesses and opportunities where additional fund layers aren't required. The point Victor makes is very, very valid. I think we're confident that our technology allows us to do that aggregation and disaggregation, and not just, as Victor correctly mentioned, the subscription and or redemption, but also the entire life cycle. I think there's a broader question, which is the entire, what I would call, plumbing of the industry, and whether it's set up for this. And the use of, certainly from a European context, the nominee model of investing into funds, which is not the same in other markets. But it's as we move vehicles, as we move an asset class that historically has been in a kind of an institutional closed-end vehicle through towards something that someone said in the previous panel looks a bit more like a mutual fund, then what that move is doing is stressing the existing market infrastructure. And as the volumes grow, you'll see that stress continue to show. So I think we feel that we play a very relevant part of that.
So, Victor, what changes or innovations are you planning in terms of fund distribution, reporting, and operational efficiencies to leverage the opportunities created by the ELTIF reforms in 2025?
Yeah, the answer is a lot, Stefan, and that's mainly because there's a lot to do here, right? What's essential at this point is that we normalize and almost industrialize the distribution of the ELTIF. If we want to make it look and feel like a mutual fund, then that's the mindset, that's the volume we need to generate. Having said that, from an operational client support perspective, the ELTIF and any other retail alternative product right now doesn't have a home in most admins, in most asset managers, in the sense that everyone has a specialization either in mutual funds or in alternatives, or perhaps in both. No one has a specialization in these retail alternatives, so inevitably it sits somewhere between the two. And what I see from platforms, what I see from distributors, is a willingness and a keenness to have the products on their platforms, have it on their roster, make it available. But then they essentially internally within their own houses are borrowing from both sides of the fence. They're borrowing, some of that sort of fund accounting capability from the alternative side, and they're borrowing the onboarding, the trading bit from the mutual fund side. There isn't a real commitment to really, industrialize this thing, come up with the right systems, come up with the right fund accounting systems and the TA systems that can do this. And look, this is presenting an opportunity for a lot of the fintechs and a lot of the the more specialist players in the market. And I do get invitations and emails and meetings where, with all sorts of players I wouldn't perhaps have traditionally spoken to, and they do have some very viable products that can potentially handle these. But I don't see any of the more traditional big houses really committing to create almost a third channel within their house that's going to handle these. They're desperately trying to economize on costs and figure out, can it sit on our alternative side of the fence? Can it sit on our public side of the fence? And at some point, it's a chicken and egg situation, but we've got to start making moves and start innovating to accommodate for these products much better.
Well, thank you very much. Very interesting. Maybe a follow-up question. So how do you plan to address the liquidity constraints often associated with long-term investment vehicles?
Yeah, that's difficult, right? You can't get the same returns if you then want a liquid product, right? There has to be an element of the illiquid bit being there, and it is what it is. It's education around how the fund is structured and how you do how the liquidity profile of the fund works. I don't think there's anything to deal with as such, but we are building in concepts around full redemptions, and maybe you take a certain percentage, but then you pay a little bit in the fee, etc. It's what everyone else is doing, Stefan. But you can't not have the liquidity be any different. That's how I view it.
Okay, thank you very much, Vic. Maybe one last question for you. With greater distribution of the ELTIF and other more liquid alternatives, what are the operational challenges that you see with managing volumes? And that comes back to the comment that Tom made a few minutes ago.
Yeah, managing volumes, I'm going to tell you exactly what I said before. It helps to have iCapital. I'm not advertising for iCapital, Tom, but it does help to have an iCapital solution or similar. it would also help, if those large platforms distributors, are able to aggregate and run those, omnibus accounts. But look, the biggest operational challenge is system based. There's so many things I do know right now that are happening within various fund admins, either at the fund accounting or the TA level, that they're off to the side. They're on an Excel spreadsheet off to the side because the system they've got in house right now doesn't quite accommodate, that piece of the fund accounting, or that piece of the liquidity management, or that piece of the, the capital call or distribution process. And again, it is that chicken and egg situation where top down decisions need to be made on whether, we're going to invest in the ELTIF and similar retail alternative type products for the long term and build the systems, or we continue to, work our way through it, borrowing a little bit from both sides until we get the scale. You do that, you're gonna risk potentially not having the scale in your business.
Thank you very much, Vic. One word you want to add, maybe Tom? You're not obliged to.
No, I'm not biased, but I am trying to sell our capital to people. No, I think Victor's exactly right. I think what we see, and obviously we work with a lot of players across the industry and asset managers and fund admins and everyone else. There is clearly an interest in making this a scaled industry. That requires a level of automation that we haven't seen yet. Some people are looking at it, and it's a bit like I view it as a bit like a motorway or a highway. When you go from 6 lanes to 3 lanes to 1 lane, which is, we can have, and we have spent, millions and millions of building an incredibly robust technology platform that services, billions and billions of flows of funds from hundreds of thousands of clients. But if ultimately it then goes into another institution or a fund administrator or a TA where actually things are happening by fax, and that is real, that is happening now, that there are things that require faxes, then you have a very fast process which then comes into something very slow. The thing that gives me hope is that this is seen, as I said before, a big opportunity. And it's not just for the ELTIF, and it's not just in Europe. This is a global move in terms of private markets exposure moving into the wealth channel and ultimately towards the broader retail client base. And therefore, for the global firms, whether they be on the wealth manager or the GP or the servicer side, there is a consistent move, and therefore one would assume that the kind of strategic decisions made around some of the investment required will start to come through, and you'll still start to see that impact the ability to scale this and meet volumes. And then the one last thing I would say is, of course, what if anything does DLT do to this?
Well, thank you very much, Tom, and thank you very much all for the very interesting insights. I think it's now time to bring this engaging and forward-looking panel discussion to a close. I think today's discussion has illuminated the transformative potential of ELTIF 2.0 in shaping the future of investment strategies, particularly as we look ahead to 2025. First, we heard about the exciting possibilities for new asset classes and the expansion of ELTIFs into innovative investment strategies and distribution channels that address the needs of both institutional and retail investors. Second, I think the optimism around ELTIF 2.0 is also underscored by its ability to provide robust, regulated framework while also addressing evolving market needs. Last but not least, the CSSF's dedicated team having a positive approach to support these interesting changes, foster a regulatory environment that encourages innovation, but also stability. So we do expect Luxembourg reinforcing its leading position as a jurisdiction to set up ELTIF in 2025. The challenge is now obviously to harness this potential to drive innovation and growth in 2025 and beyond. With that, I'd like to wish you all continued success, and I encourage you to carry forward the ideas and optimism that sparked here today. Thank you very much. Over to you, Maria.
Thank you very much, Stefan. Well, we have time for just 2 quick questions that have been raised in the chat. So if you bear with us and hold on for just a few more minutes, we have one question, which is, what is the minimum investment per retail investor? And do the regulations allow collective investments out of the EU? Is there anyone who would like to answer this question?
So there is no fixed minimum investment per investor any longer. So the 10,000 have been deleted and they are replaced by the MiFID framework on suitability assessment and so on. So it's no longer like minimum numerical number in the text. And I'm not sure I get the question on, is it collective investment, is it on the investor side, or is it fund investments outside the EU? Not sure if I get the question right.
Perhaps we let our anonymous asker to tell us afterwards.
Maria, if the question relates to interest from Asia in the ELTIF, I can tell you yes, we at Goldman have certainly seen quite a lot of interest.
Yeah, I think I can confirm that other countries and retail investors in other countries would be very interested to be able to easily access and invest into ELTIFs. So that is, as one of the speakers said, one of the tasks to get into a dialogue with other regulators and see if they would be happy to, once they understand the ELTIF framework, to maybe facilitate or more easily allow investments from non-European investors into ELTIFs. I think that would be a great news to share, hopefully later on.
That's very good. Thank you very much. And our second question, in case anybody feels up to tackling it, how can banks be motivated to sell ELTIF products to multiple and small retail investors? For example, Sparkasse, one of the main banks in Luxembourg, where several ELTIF products are based, as currently they have no ELTIF offer. Would anyone like to tackle this one?
I can just share that I've seen savings banks, not the Luxembourg Sparkasse, but in other countries, being very interested in having a high appetite to be able to sell ELTIFs. And some of my files have even been very pushy to get it as quickly as they could because there was a demand. So I don't know about other banks, but I do think there is an interest, and probably it also needs to grow and like get more mature now that we have the ELTIF RTS for just a few months. Probably things need to settle a little bit, but I think I'm an optimistic person by nature, but I would think it will be coming.
That's great. Well, thank you all so much for spending your lunch break with us, and a very special thank you to all of our fantastic speakers. We look forward to discussing all things ELTIF in the near future, and we wish you all a very nice day. Thank you for joining us.